some of that quality underperformance we saw in 25 was definitely coming back. And I think we see a quicker resolution to maybe what we're seeing in terms of the oil price in Iran, then actually that's still quite a good place to be.
Hello from Frankfurt am Main. We're here today talking about quality investments, and with me is Mortimer from Guinness Global Investors. Hello.
Hi, nice to be here.
Yeah, we have a tough market already, a tough year. We started with the Greenland situation, then we've got the software sell-off, and now, of course, the war in the Middle East. What's your view on the markets, and how kind of do you reflect on all these different crisis scenarios?
Yeah, you're right. I mean, it's changed a lot this year. And I think the thing to sort of recognize is how the market has shifted so much over the last 3 weeks. So what was working and now what's changed. So really kind of, as you say, Greenland, I think we went through quite quickly, ultimately, which is very pleasing, obviously, for lots of reasons. And then the big thing the market was looking at was this software sell-off. So the kind of agentic AI, Anthropic and everything, and how that moved really through lots and lots of different sectors. And it was interesting that, we were seeing the US underperform. We were seeing areas such as Europe, EM outperforming, dollar weakness. And then we've seen, what's just happened over the last 3 weeks with the Iran war, that completely turn on its head. We've seen sort of dollar appreciation. We've got maybe less rate cuts and more worries about rate increases. And clearly some of the sector movements have been very different as well. So it's been really challenging to try and navigate that. And clearly what we're trying to do is think about what might happen next and is our portfolio positioned correctly for that.
And quality, your quality investor with a quality fund was not kind of the best style in the last couple of weeks or months. What's your view on your performance, lagging behind the benchmark, and how would you say is your view on the kind of next couple of months with your performance?
Yeah, so I mean, in terms of the sort of the quality factor underperformance, a lot of that we saw was last year in sort of 2025. And in fact, markets were shifting very dramatically. So actually quality held up really well at the beginning of the year when we saw the Liberation Day tariffs. Markets fell very sharply and actually quality outperformed. It was a really good period showing the defensive characteristics. Once we then had the reverse of that, if you like, when the 90-day pause and so forth, you then saw it change a lot. And it was actually US growth did much better again. A lot of those big tech companies. You also saw more speculative growth in the US do really well. And on the flip side, somewhere like Europe, you saw value do much better. So it was things like banks did better, utilities on the AI trade, and then obviously some of those defense companies. And so if you think about that latter part, that's really when the market sort of quality as a factor underperformed. You might have a bit of exposure to those sort of big US growth names, but maybe not as big as the benchmark. And then areas such as those European value names, you have a lot less. Particularly that was the case for our fund. However, at the end of the year, we start to see more of those worries come about for the AI and software and valuations and the CapEx spend. And actually quality starts to do a lot better through November, December. And then pleasingly, as we started this year, I think that quality factor did a lot better. We were seeing strong performance from areas like consumer staples, for example, massively outperforming areas like software. And over the last few weeks, I think that's, we've just seen a lot of volatility. I think our view is, some of that quality underperformance we saw in 25 was definitely coming back. And I think we see a quicker resolution to maybe what we're seeing in terms of the oil price in Iran, then actually that's still quite a good place to be, particularly if you've got more uncertainty, rate changes, differences going on in the market, those sort of the characteristics of good, stable businesses, I think could be well rewarded again. So we're quite positive on that going forward.
As you mentioned, quality tends to be a bit more stable, a bit more robust in this current environment, possibly a good thing for the portfolio. So how positive are you looking forward for the quality style?
Yeah, I mean, I think we would always be looking at it from a long-term perspective. So if you're talking about 3 months, 6 months, 12 months, it can be a lot different, as we've just seen, right? Things change so dramatically. However, what we're always thinking about is that kind of 3-5 year type period. And I think history has shown, why would you buy kind of the quality factor or a quality fund, is that you can see strong outperformance over the long term. Now, in the short term, that can shift around. But I think when the benefit of quality, if you like, and what we're particularly looking for in the Global Equity Income Fund is that sort of defensive nature in difficult markets. We're still trying to capture the upside, but we recognise we can't capture all of it. And I think markets that we're currently seeing at the moment, whether it's the Liberation Day tariffs, whether it's wars, etc., whether it's changing kind of interest rate environments or worries around growth. I think that's kind of where we're shifting. That's where the market's got more worried about inflation upside and maybe growth downside. And we've seen that before, and that's, we think that's just the type of environment where the market starts to reward those companies again. As I say, we saw that at the beginning of this year, and we think that's, there's a good potential that could continue going forward.
And having a look into your portfolio, how are you currently positioned, and did you adjusted your portfolio, did some changes?
Yeah, so I mean, the portfolio is fairly stable, so we have a low turnover type of approach. We still got a good balance between sort of more defensive areas like staples and healthcare, but also good exposure to more cyclical areas like industrials, financials, and so forth. So we think the balance is good, in that we're not just completely focused on the downside protection. Right? We do want companies that can capture that kind of economic growth potential. In terms of changes, we have made one change so far this year, and that's really to try and take advantage of some of the big market sell-offs we've seen, particularly in the software space. So Relex was a company that we'd looked at for a long time, we'd really admired in the UK market, and that was actually one of the main areas that got hit first. And so their exposure to some of the legal side of the software business sold off very heavily. We thought that was probably overdone. It was then trading at much more attractive valuations, much better dividend yields. We thought that was a great opportunity for the portfolio. So it's always the balance between the volatility is challenging, but it can open opportunities. And I think that's what we're trying to do within the portfolio.
So having a stable portfolio with a quality style in a maybe unstable market. Here's Ian Mortimer from Guinness Global Investors. Thanks.
Thanks very much.